In this video, we're going to be performing a deep dive on Emerson Electric's dividend safety. To begin, let's talk about Emerson Electric's business model. Emerson Electric is a diversified industrial manufacturing firm. The company was founded in Missouri in 1890, and since that time, it has evolved through organic growth as well as strategic acquisitions and divestitures from a regional manufacturer of electrical motors and fans into a $43 billion diversified global leader in technology and engineering. Emerson Electric's global customer base affords it $19 billion in annual revenue. Emerson Electric is a well-known dividend stock because of its compelling track record of dividend growth. With 61 years of consecutive dividend increases, Emerson Electric is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, Emerson Electric's dividend history allows it to satisfy the requirement to be a dividend aristocrat more than twice over. With more than 50 years of consecutive dividend increases, Emerson Electric is not just a dividend aristocrat but also a dividend king, an even more exclusive group of dividend stocks with more than 5 decades of annual dividend increases. Looking ahead, Emerson Electric's high dividend yield has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Emerson Electric's dividend safety in the context of the company's current earnings. When Emerson Electric reported fiscal 2018 financial results on November 6th, the company reported that it generated $3.46 in earnings per share for the 12-month reporting period. For context, Emerson Electric currently pays a quarterly dividend of 49 cents per share, which implies a payout ratio of 57% using 2018 earnings per share figures. Using earnings, Emerson Electric's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Emerson Electric's current dividend payment to its free cash flow. In fiscal 2018, Emerson Electric generated $2.3 billion of free cash flow. During the same time period, the company distributed $1.3 billion of common share dividends for a free cash flow dividend payout ratio of 57%. Using free cash flow, our conclusion is the same. Emerson Electric's dividend appears safe for the foreseeable future, and its payout ratio using free cash flow is actually identical to its payout ratio using earnings per share. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Emerson Electric's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Emerson Electric's performance during this time period is shown here. Emerson Electric's earnings per share declined by 27% peak to trough during the last major recession. With that said, the company's earnings continued to cover its dividend payment, and it continued its multi-decade streak of consecutive dividend increases. While Emerson Electric is far from the most recession-resistant dividend aristocrat, that title likely belongs to either Johnson & Johnson, McDonald's, or Walmart, it is unlikely to cut its dividend due to weakness in the broader economy. The last angle that we will use to assess Emerson Electric's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. In fiscal 2018, Emerson Electric generated $193 million of interest expense and had $3.8 billion of debt outstanding for a weighted average interest rate of 5.1%. The following image shows how changes to Emerson Electric's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Emerson Electric's weighted average interest rate would need to rise well above the 20% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Emerson Electric's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.